Good morning, everyone, and welcome back to Retirement Plan Academy. My name is Zach Hurst. I'm with the Trust Company of Tennessee, joined by two better looking people than me on screen, Adam Davies, my partner who heads up our retirement plan services out of our Knoxville office, and Farzan Qureshi with BlackRock, who spends considerable time within target date funds, which is our topic today. It's something we're going to cover in depth, and hopefully it's something that all of you as plan sponsors on this call, or those maybe who are on committees, have explored and hopefully have within your plan. They offer a lot of simplicity and are easy to understand for your employees. So it's an important topic, one we're going to spend quite a bit of time on today, but we promise we won't keep you too long. Before I go further, I've got some housekeeping items to cover. The first is on your screen, you're going to see a box that says questions. So if you have questions as we go through this, please jump in, share those right away, and we will get to
Hey,
those.
Zach, hi.
Yeah.
We'd love to follow along with your day, but your reminders are up for us too. Just letting you
Oh,
know.
I'm sorry. Let me just close out of this altogether. Sorry, everybody. Okay. All right. Am I out now?
Yes.
Okay, great. Thank you. So again, you got a questions box there that you can jump in, ask questions as we go. We'll answer them as we go or save time at the end. And certainly those of you who need CE credit, be it SHRM, HRCI, or CPE, we have all those available. And 3 reminders for CPE and really everybody. You do need to answer 3 poll questions, audience poll questions that we put on. You also need to stay for at least 50 minutes. We promise we won't keep you much longer than that. And you need to fill out the evaluation form at the end. So with that, gentlemen, I've already sort of semi-introduced us. I think we will skip anything further and jump into target date funds, what we're talking about, and why we're talking about them. So Adam, there's been significant growth within the space, and want to let you kind of talk to us about how these started, what they do, and where we are now with those.
Sure. And so I think it's pretty neat how legislation can impact, different outcomes, whether that be, retirement or how participants are invested. And so if you think back 20 plus years ago, if you were a plan sponsor, you might have been reluctant to default a participant into any sort of aggressive investment option. Even though we know that investing in stocks and equities over 30, 40 plus years is going to be the right outcome for participants. A lot of plan sponsors were reluctant to take that jump because they were concerned that there could be a potential lawsuit if the market went down and they had defaulted participants into that aggressive stock option. So what really kind of kicked off the growth of target date funds was the Pension Protection Act of 2006. And essentially that provided a safe harbor for plan sponsors to default participants into, perhaps a more appropriate investment option, as long as certain criteria were met. And essentially these QDIAs, they're called, qualified default investment alternatives. They need to be sufficiently diversified to minimize the risk of large losses. And so you can see once that went into effect in 2006, the growth of target date funds has just exploded. And for most plans, they're the default investment option, as well as making up a pretty substantial part of the 401k investment universe.
Oh, sorry guys, let me go back one here. And what I want to do here, Adam, before we move on and get further into this, is launch our first poll question. So for anybody who joined us a little bit late, this is a requirement for CE credits that you must answer the poll questions that come up. Again, we have 3 of them. They're fun, they're interactive, so just take a second and fill this out. This question is, what is the most popular investment in your retirement plan? Is it target date funds, risk-based portfolios, equity mutual funds, which are stock funds, or fixed income mutual funds? So as Adam said, perhaps it could be the top one. I don't know the answer to this yet. It could be the top one. Maybe several years back, it was probably the bottom 2. Is that fair to say, Adam?
Definitely. And, I worked with a plan a while back that the default investment option was stable value. And, even 10, 15 years later, bond fixed income mutual fund was still the primary. It was more than 60% of the plan assets.
Yep. We'll see here, target date funds being the #1 answer. Adam, what do you have for us? Did they get it right?
They did, yeah. So
Right.
probably not surprising given that previous chart that target date funds are the most popular investment option for a lot of plans.
Yep. Good deal. So DOL tips. So these are for ERISA plan fiduciaries. Again, people on this call, many of you might be involved with your 401k plan at work. Perhaps you are the plan sponsor. So this is to help guide you into things that have come out in terms of what they suggest. So Adam, talk us through this a little bit.
Yeah, so once the PPA was passed in 2006, you saw the growth of target date funds just exploded. And so the Department of Labor took note of that and said, hey, this is becoming such an important investment option in a lot of retirement plans. We need to put out a few tips or recommendations to make sure this is done the right way. So of course, any time the Department of Labor issues some guidance, that's something we all need to pay attention to. And so these are some of the tips that they came out with. So if we go through them quickly here at a high level, we'll go into each one into more detail in just a minute. But first and foremost, you have to establish a process for selecting and comparing target date funds. There's more than 50 different types out there. How do you select the one that's right for your plan? So then, once you've selected that, you need to have a process for ongoing review. You should understand the fund investments, its fees. You should inquire about custom or non-proprietary options if that's a good fit for your plan. Develop effective employee communications. And then, of course, one of our favorite recommendations is document the process. If you didn't document it, it didn't happen.
So question on this, Adam, or Farzan, feel free to jump in here as well. But so DOL tips for target date funds, right? The first one is establish a process for selecting and comparing. Maybe I missed this on the front end, but is that saying that it's mandated that a plan has to have a target date fund within their lineup?
It is not, no.
Okay.
So this is saying that if you've selected a target date fund, this is the process by which to go about that. When we talked about a QDIA, qualified default investment alternative on the previous slide, not all plans have target date funds as their QDIA. Some might have a risk-based portfolio, maybe a balanced 60% stock, 40% bond portfolio. We've seen a trend lately in some plans using managed accounts. So target date funds aren't the only option, but they're certainly the most popular.
Gotcha. And if you guys, Farzan, maybe for you, have you seen anything coming out in the last 5 years or so that seems to be pushing plan sponsors more and more this way, or do they still have a lot of freedom to choose between those different options?
I think there's a lot of freedom to choose between options, but certainly I think target date funds are becoming the gold standard in terms of what large institutional plans are doing, right across the board, from large institutional plans all the way to smaller plans. You see this in Canada, you see this in many countries around the world. Target date funds are effectively becoming the gold standard. And when you look at the numbers, it's sort of like 70 or 80% of plans, especially in Canada, maybe it's about 85% of plans have target date funds as the default. I think in the US, it's somewhere in the 70% range of plans that are using target date funds as a default. So definitely a lot of popularity and a lot of support from the consultant community, from other kind of stakeholders within the whole retirement system.
Got it. Thanks. And before I move on, let's go with some more fun. Poll question number 2 will come up. And again, we do have people joining a little bit late, so I just want to remind those who are seeking CE credit for any of the 3 that we are offering, please do take time to fill this out. Please, everybody, take time to fill this out and let's have a little fun with it. How long have you held your current target date funds? If you are a plan sponsor, if you're a participant, however this might apply to you. And you see the answers: less than 1 year, 1 to 3 years, 3 to 5, and 5+. Guys, while they're doing this, I'll tell a very quick story, and I think I've told it at some point months ago as well, but my wife started a new job last year, and she sent me the 401k info and basically just said, what do I do? And there must have been like 75 or 80 investment offerings. I mean, it was brutal, so I'm like, I don't want to go through all this. So I start looking for the target date funds, which I strongly believe in and I hold myself. And there weren't any, right? There was some other, I don't remember what it was. There was some other option that 2 or 3 very general options that, it just wasn't easy to select what it was. So I spent an entire night digging through 80 different investments because there was no simple solution, and so I'm in the business, right? And I do this and it was still a pain. So I just feel bad for people who do not have the simplicity that many plans have. You see the answers here: 5+ years. Farzan, Adam, is that good, bad, indifferent? How do we read this?
I would say that's indifferent, but I think it is indicative of the fact that there needs to be such a big communication effort going into target date funds and how they operate, since they are the default investment option, that once you select it, most plans tend to keep them for quite a while. And that's exactly why the DOL wanted to put out these tips, to make sure that you really have a consistent process and you don't just pick it and never revisit it.
Got it. Okay, let's move on. As Adam just said, we are going to sort of dig into some of these recommendations from the DOL as it relates to target date funds. The first is the selection and review process. Adam, are you going to read every word on the screen?
I sure will.
No.
I plan to take up the rest of the webinar. No, we won't do that. But one of the most important things to the Department of Labor, and really it's just a good best practice overall, is that when you're picking that initial investment or you're relying on your advisor to pick it for you, what's that consistent process to make sure it's done in the best manner possible. And so you see there's a lot of target date funds that you could choose for your plan. So how do you choose the one target date suite that's best for your plan and your participants? So what a lot of plans or their advisor will do is, of course, look at the numbers. What are the investment returns? What are the fees? What's the volatility? What's all these different risk metrics. Also, it's sometimes good to look under the hood at different qualitative factors. So, who's the team actually running it? How long have they been doing it? Have there been any departures? So we think combining that quantitative and qualitative approach can lead to the best results over time. But, that's not the only way to do it. So some people can rely on outside opinions or ratings. What you're looking at, that chart to the right, is Morningstar's rating. And so what they've done is they've rated a lot of different target date fund providers: gold, silver, bronze, or neutral. And you can see BlackRock, our guests for this webinar, are right at the top. They're one of the highest rated target date fund families. And so that did come out of Morningstar's quantitative and qualitative approach. If it might be hard to see, but if you look towards the top right, they have some different pillars. And so they look at the people, the process, and the parent.
And first on, is this something that we see a large list here, right? So thinking about plan sponsors on this call, where do you start? It seems like this is an ever-growing list. I mean, is anybody that's remotely involved in the retirement plan space now offering target date funds? I mean, has this list just grown substantially in the last 10 years?
Absolutely. I think it's a huge list. This is not exhaustive. I think there's about 65 target date funds in the US market today, and that list continues to expand. As we talked about, given that they're becoming sort of the gold standard and the primary default option in many plans, you see all different managers launching funds in this space. And so it's an evolution. We've seen lots of funds around. BlackRock's been around. We invented the category in 1993, so we've been around for a really long time. But as you can see, I think, in Morningstar's kind of recognition here, they have a pretty exhaustive approach, really deep diving and coming in to meet with managers to really understand the people and the research of who's running these funds, the process, and what the parent is like. Are we going to be around for a long time? Are we in and out of the market? Are we selling our funds, or are we selling the organization? So I think there's a lot of deeper dive that you can do, but certainly I think that list is expanding further and further. But I think there's lots of research in terms of who's been around for a long time and who's been doing this as well.
Yeah, and in terms of that research and sort of this little cut and paste that Adam put on the slide here, for the plan sponsors and those involved, this is not something you need to go do on your own, right? Spend time doing. You don't have time to do it. We realize that. You likely have an advisor on your plan. Put them to work, right? You're paying them anyway. Make them go do this research for you. Come back and present something like this to you. Even if you already offer them, as we do through BlackRock, to me, a participant, it's really comforting to see where we rank, right? So just spend the time, maybe do this once a year, whatever it might be, and just understand where your provider falls in terms of rankings. Adam, let's continue on with the understanding of the fund investments. I like this a lot, and I want you to talk to us. I know you're going to, but spend a little bit of time about to or through retirement. We're in a very rocky period of the markets right now. We're dealing with many people who are 60-something years old considering retirement. They're really, really worried about what that number is at retirement, right? To retirement. and try to educate them on investment strategies through retirement. So I've talked too much. I'll let you take it from here.
Sure, and I know we have different plan sponsors and attendees on today's call of varying experience with target date funds, so it might be worth just taking a step back for a second and, why are they called target date funds? How do they operate? So they're called target date funds because they're targeting a date that you might be reaching retirement. For most folks, that's historically been around age 65. And so one of the compelling features of target date funds is that they start out very, very aggressive, nearly 100% stocks in many cases for a participant that's in their 20s. But then as time goes on, that mix of stocks and bonds, what we refer to as the glide path, will automatically change and get more conservative as you get closer to retirement. Now, what we see in the target date fund universe is that there's really two different camps of funds, what we call to funds, and then the other is through funds. And what that's really referring to is that glide path and how does it change, when is it managed, when does it stop changing. And so what we see our to funds are managed to retirement. So if you look at that orange line there, the glide path kind of freezes right at the vertical gray bar. That's the target date when a participant would reach age 65. And you can see the mix of stocks and bonds no longer changes at that point. There are other target date funds called through retirement where that mix continues to be managed even beyond retirement, through retirement. And so we might see that orange line drop all the way down to maybe 25 or 25% stocks at age 95. So it will always be changing even beyond retirement.
So Farzan, does BlackRock and Vanguard and whoever else, you can obviously speak to BlackRock, but does the firm decide whether they're going to be a to or a through, or do you offer both options?
Yeah, typically I think firms are in one camp or the other, as Adam mentioned. For BlackRock, we've spent a lot of time. I mentioned we invented the category. We've spent a lot of time on this concept around to versus through. We are decidedly in kind of the to camp. That's not to say that as we reach that retirement goal, if you see the orange line there, as we reach that retirement age, we're no longer managing the kind of set and forget it. It's deliberate, the actual allocation in retirement to manage it and keep it consistent at a 40% with 60 income level is deliberately done. And a lot of research around this, and we protect participants being effective. If you thought it as you continue to come into retirement, expecting as a retiree to lose some assets from your portfolio. So withdrawing assets at the same time, you reduce overall equity content from target fund, and you down it. You have a triple whammy. It's really difficult to kind of make up.
This may just be me, but I was experiencing a little bit of a lag there with Farzan's audio.
Yeah, I am as well. Farzan, if you can hear us, we've got some lag from you and some little choppiness. So we will let you try to work on that for a second and move on just to be safe here. Adam, I'll give him a second just to try to catch up.
Sure, and maybe just before we switch this slide, I think one of the interesting things that, if I were a plan sponsor on this call, is knowing that not all target date funds are the same. And so you can see, you might have 2 20-30 target date funds, but the amount of stock or bonds they have in each one can be dramatically different between the two. So what we'll see is that there's pretty aggressive target date funds, there's conservative, there's ones in the middle. So that's another layer of complexity in addition to just the to versus through question.
Yeah. And Adam, this is the always the fun one, the one that everybody has to be focused on, and that is the fund's fees, right? So the underlying expenses of these funds. So talk to us a little bit about this.
Definitely. And, at the trust company, we don't like fees more than anyone else, and we try to minimize those as much as we can. They are a necessary part of investing. Of course, you have to pay BlackRock a fee for managing these funds, picking the stocks and the bonds. But of course, we want to minimize that however possible. And I think the real incentive to do so is that not just because, that reduces fees or increases account growth, but from a participant standpoint, that can really increase the amount of years of spending. And so, here's an example. Certain assumptions are made, but if you were to reduce a fund's fee by 0.5%, that could translate to an additional $100,000 at age 65 for that participant, which equates to another 5 years of spending. If you went as far as to reduce those fees by a full percent, that could mean an extra 13 years of spending. I mean, that's a huge impact for participants. And one of the reasons why we've chosen BlackRock and really like them is that their fees are exceptionally low. The fee is what we refer to as 9 basis points. That is 0.09%. So to say that a different way, if a participant were investing $1,000 into these BlackRock target date funds, the annual fee would be just 90 cents. So exceptionally low cost.
Yeah, it is. And as I've explored this a little bit, Adam, and you're the expert on this far more than I am, but it seems like there's still a way too large of a range here in fees with target date funds. And when I've worked with people who have said, can you look at my plan outside of trust company and help me out here? The answer is, of course, right? And some of them have had target date fund lineups, and I could be misremembering this, but I'm pretty sure it was like 0.35 to 0.4%, right? Versus a 0.09. That just seems like a substantial range.
I've even seen target date funds with expense ratios as high as 1.2. Certainly that's a pretty substantial jump from what's available through providers like BlackRock at 0.09%. So yeah, I mean, there's a very wide range of fees, and so you can see the impact of reducing those fees by 0.5% or a full percent. I mean, that could be another decade of spending.
Yeah. And so again, plan sponsors on the call, those on committees, check with your advisor, and if you know what the fees are, right? That's the first thing. And if you feel like it's high, ask the questions. Maybe there's a good reason for it, right? Maybe they're going to show some type of performance or some reason they chose that one versus something else. But just know that there's some really, really quality options out there with very low fees as it relates to this target date fund space. So with that, let's launch the third poll question. I am sorry to be on repeat for the rest of you. There are, again, some late arrivers, so those seeking CE credit, please do take time to fill this out. And the question is your plan using target date funds proprietary to your record keeper? And so what that means is if your record keeper, and let's pick on Vanguard, right? Just pick one. If your record keeper is Vanguard, are your target date funds Vanguard target date funds? And Adam, while they're answering this, is there a right or wrong in this?
Not necessarily, but it all goes back to that first point the Department of Labor recommended, in that if your record keeper is Vanguard and you chose Vanguard, why did you pick Vanguard?
Yep, right. And that's it. I think that the reason for that is that would mean that Vanguard is collecting twice on fees, right? Record keeping fees plus whatever that underlying investment fee is, right?
Definitely.
Okay. So we'll give just a second
Yeah,
here.
maybe I would just add, I'm back. I think I was cut off there from for a little second there. Sorry about that. But I would add that I think the due diligence you want to do, you do due diligence when you're selecting a record keeper. You need to do that same kind of due diligence when you're then selecting the target date fund. And those kind of decisions should be separated in a way, as opposed to, just picking the record keeper and the target date fund at the same time. I think that's kind of the view of the Department of Labor as well.
Gotcha. And so the results popped up for a minute and looked like it was really kind of mixed. Some didn't know, and there you have it. More yeses in terms of the target date funds being proprietary. So again, that's as Adam just said, and Farzan as well. That's not right or wrong. It's just a matter of having a process, doing due diligence, and following that process to understand why you're selecting that one versus others that are out there. All right, gentlemen, let's continue on. We have custom and non-proprietary options, as we just mentioned. So Adam, talk to us a little bit about this and what might be best for the plan.
Sure. So two different topics here, but we can start with the custom one first. And so there are options to create a custom target date fund. That differs from what BlackRock or Vanguard or another provider might offer, quote, off the shelf, where you purchase the mutual fund. It has a ticker, and you just kind of purchase it as is. There is the option in some case to totally customize the mix of stocks and bonds, that glide path, how it changes. Specific to your plan and your demographics. What we see though in practical sense is that really only very, very large plans use this. Historically, it's been the plans that are $1 billion and more, or even lately it's kind of been in that $100 million space of assets just in target date funds. So we don't see it too commonly across a lot of normal sized retirement plans, but it has been a trend in some of those very, very large plan markets. Kind of moving to the second one, proprietary target date funds. That's what our poll question was asking. And so when the Pension Protection Act came out in 2006, what we saw were a lot of record keepers. Zach, you used the example of Vanguard. They would introduce their own target date funds, and a lot of plan sponsors or a lot of advisors said, hey, we're using Vanguard for a record keeping system, let's add their target date funds. That makes sense. And so if you look in 2010, about 67, 2/3 plan sponsors used that proprietary record keepers target date fund. But we've definitely seen a shift away from that over the last 10 years. And I think that that's for the better, and that a lot of committees have said, we do need to do that due diligence. We do need to rely on our advisors. We need to roll up our sleeves and not just pick the one that our record keeper is offering. We want what's in the best interest of our participants.
And really, I mean, good for plan sponsors and committees, right? Because as Farzan mentioned earlier, over the last 10 years, the list of record keepers who are providing target date funds has expanded substantially, right? And even with that, it's reduced so much, like you just mentioned, Adam, 67% to 23% in terms of those actually using the proprietary, if I'm reading this right. So that means people are doing due diligence and the research they should. So kudos across whatever poll this might be that we're talking about. But we will move on to employee communications, which perhaps is the most important part of this. Investments are confusing for people. A lot of people just say, what am I supposed to do? Just, can I do something and just forget about it? And that's probably what we're talking about here, Adam.
Yeah, so there's several different layers or ways to introduce people to what their default investment option is, how target date funds operate. Of course, the government mandates annual disclosures, these QDIA notices, so that participants receive that piece of paper saying, if you don't choose something different, this is how your money will be invested. And so that is distributed annually. Most participants don't look at that, and that's okay. So probably the more effective way is by doing employee meetings, having conversations around what actually happens. We have an example here of our employee materials, and as part of that, we walk through and say, hey, there's different types of ways to invest in the plan. Here's a target date funds. We might use an example and say, if you were born in 1980, this is the target date fund you'll be invested in. Here's how it's going to change over the next 5 years, 10 years, 20 years. Here's what it's going to look like at retirement. And one of the reasons I think that's so important is there was a study that came out in 2017. And so it polled participants and said, tell me your thoughts about target date funds, answer this question. And probably the most shocking result to me was that 40% of those people polled thought that target date funds were FDIC insured. So obviously they're not. They are invested in stocks, bonds, things that will move up and down with the market. But it goes to show that a lot of participants, might not have been exposed to them, might not know how they operate. And so you don't want there to be any surprises. You want them to have that growth during good times, but you also want them to know how they're going to operate during market volatility, just like what we've seen over the last quarter.
Yep. And Farzan, one question came in a few slides ago, I think, and I didn't get to it, but let me jump in real quick. And the question is, are target date funds targeting a retirement age of 65 or 67 or something else?
They're typically targeting 65. So, the default would be your birthday, and then based on that, the target date fund that gets you to age 65. But participants can individually choose which target date fund they want themselves, and they can proactively choose a different one to match them at age 70 or age 65 or age 60. So, but the default generally is target dates are really designed to get people to age 65 at the target date.
Yeah, and you bring up a good point there about them being able to choose, and we've dealt with that quite a bit as an advisor in the space, where we have somebody who wants to be riskier, right? Take on more equity risk, and they're 50 something years old, and they're saying, can I go all the way back to, target date 2055 or whatever it is? And the answer is yes. And a lot of them choose to do that because the costs are very low and the performance is done really well. And so instead of shifting into some other mutual funds that are offered in the plan, they just want to shift back and stay within target date funds. So again, a good place for your advisors to come in and make sure your people understand their options within the target date fund space. Last one on this section, and this is what plan sponsors probably get so tired of hearing, but we'll say it one more time anyway. Adam, talk to us about documentation.
Sure. So, the Department of Labor was very thoughtful in outlining all of these tips that plan sponsors should consider. And so if there ever were to, be an audit and they say, hey, have you done these things? You would need to rely on meeting minutes or, perhaps reach out to your advisor and show where they've documented the process. And so if you can't document it or, produce those materials, those minutes, then in the DOLs, it didn't happen. So a lot of committees don't take the time to necessarily do this in their meeting. They rely on their advisor for that. So I would say this is probably more for the advisor to, document why they've chosen their provider, monitored it on an ongoing basis to see how it's changed, the performance, the fees, all of the things we talked about. But it might be worth asking the question to your advisor, hey, have you done this? Could you provide this documentation? Tell me about your process.
Good, and we're going to jump into the BlackRock target date funds and really how this is built out. So, Farzan, I think maybe the easiest way I can put this, and you feel free to disagree if I'm wrong here, but we think about when we the advisor approach participants, we think about target date funds as simple, right? Easy to understand, simplicity in terms of how it's going to operate for them. But there's so much detail that goes on behind the scenes from you and other providers in terms of putting this together, and probably the reason why they are so strong in their performance while maintaining low fees. So I think we'll spend the next few slides sort of going through what you all do and what you think about as we put this together. So feel free to jump in here and take us through why we're here and what we're talking about with Global Retirement Solutions.
Thanks, Zach. I think you're right. I mean, the target date funds have been designed for participants, and they're designed for simplicity for participants. They need to just pick the target date, the date that they need the money, and go and invest in, and just stay in that fund, stay the course. But under the hood, as you've talked about, under the hood, there's just so much going on. And we'll try to get into that a little bit today. But really, on this page, we wanted to kind of share that obviously BlackRock has been around for a really long time. We actually invented the category of target date funds in 1993. So we've got about 30 years of experience of running target date funds for participants that help them through this multi-decade accumulation journey. And that multi-decade accumulation journey in experience, we've already seen kind of the dot-com boom and bust. We've seen 9/11, we've seen the global financial crisis, we've seen COVID, we've seen so many different environments, and we've evolved and adapted and thought about how target dates work in all those environments. Now, we're a global firm, as you can see from this slide, invented target date funds in the US in 1993, maintained a leadership position there, started in Canada, and you can see around the world, 9-10 different markets where target date funds are becoming the dominant kind of investment vehicle for plan participants. So there's a real movement towards simplicity for participants. They don't want those 80 different options that your wife got, Zach. It's really difficult, analysis paralysis, when you're getting 80 different choices to go through and you're not an investment professional. They just want real simplicity. And target date funds are really designed to help participants in that simplicity journey. But, as we kind of go through the next page, we'll give you a sense that, what does that mean? What does this 30 years of evolution mean? There's a lot of different things that we've done, whether it's in different markets, but also that evolution, as I talked about, in terms of we've seen the dot-com boom and bust. We had to increase equity allocations. We thought about changing the glide path as things have evolved. As we've understood longevity, participants are living longer in retirement. Retirement isn't just 10 years, it's potentially 30 years as we go, as people are living longer. And so we've evolved and changed over that time. We've added new asset classes. We've thought about income. there's lots and lots of evolution that's happened since the first target date fund was launched in 1993. I'm not going to go through all these details, but to give you some sense, I think the next page will give you a good sense of kind of how we actually build these solutions.
So Farzan, maybe
go ahead, Adam.
Maybe one question while we were on the previous slide. So, we mentioned that you want to have a process for monitoring as time goes on because, BlackRock and other providers don't necessarily just keep the target date funds the same. And so, like, I remember back to 2014, you all had a pretty significant change in the glide path. Are you able to just speak to some of the thought that went into that change?
Sure, absolutely. We looked at kind of how participants are earning their income over their lifetime, what is happening in terms of longevity, which is, has been increasing over the last number of years. We look at the Society of Actuaries kind of thinking about what is that longevity increase and how is it, taking part in our population. And so using some of those inputs around, where longevity is headed, as well as in terms of how participants are earning their income, really moved us to change that glide path, taking a little bit more risk on earlier for younger participants, keeping that 100% equity or 99% equity level for a number of years, and then changing that equity landing point from 30% to 40%, recognizing that we're living longer, participants need more equities and need more accumulation and the potential to grow even in retirement. So those types of changes that we've observed in the marketplace in terms of our inputs, in terms of longevity, in terms of how participants are earning their income, really told us that, hey, look, how you earn your income, affects how you save income and how you invest that income. And so all those types of inputs have really led us to the glide path as to where we are today.
And I'll get us back to this page, Farzan, if you want to keep going with the blends and some of the things you have here.
So these are broadly our inputs that we're looking at when we're building our LifePath portfolio and our model. Now, we talked about this being, a quantitative model that we're really taking in different inputs. We're looking at life expectancy, as I talked about. Life expectancy, not just about how participants, how old they're, what the average age is of mortality in the United States, but also probability. Like, what is the probability of a 65-year-old living to 75? What's the probability of the 75-year-old living to 90? So understanding that is part of our model. Understanding market expectations. So what is U.S. equities, the S&P 500, projected to deliver in the next 10 years over a really long term? What is the U.S. bond market going to do? What is real estate going to do? So looking at the broader BlackRock to come up with capital market expectations around what we expect that long return to look like. What is the risk? What is the standard deviation of the volatility of those assets? And how do those assets correlate with each other? When one is going up, the other is going down. When bonds, there's changes and shifts in how those assets move with each other in relation to each other. And so we look at all those things as part of our model to understand how we should actually build an asset allocation of stocks and bonds that's shifting over time to meet those clients' accumulation journey. One important aspect is also income. We're looking at the panel study of income dynamics from the University of Michigan. This is the longest longitudinal study of income anywhere in the world, basically looking at Americans from the 50s, 60s, 70s, 80s, 90s, 2000s, and 2010s in terms of how we earn our income over that time. The average American, how do we earn our income? What is the shape of that income? What does our spending look like? And what is our ability to save? And maybe on the next page, to give you a sense of why that's important, that red shaded line there is how average Americans earn their income over their lifetime versus inflation. So we're beating inflation nicely until about 10, 15 years, 20 years to retirement. In our late 40s, early 50s, we actually stop beating inflation, and we might be working less. We're still getting some pay raises, but not quite as much as inflation. that black line is the spending line. We know what people are spending because we know what they're spending. We know what their ability to save is as well. Anything that you're not spending, you're saving. So that orange shaded area on the left-hand side, that is your savings capacity for the average American over their lifetime. Obviously, early on the left-hand side, very little savings capacity as we spend all our money as paying back student loans and all that stuff early on. And as we kind of go through our lives, you can see that orange shaded area becomes bigger and bigger. Now, our goal in LifePath is to deliver that orange shaded area as your savings. We want to multiply your savings over your lifetime by the investments to deliver you that pink shaded area on the right-hand side, which means we want you to have a smooth consumption capacity all the way through your accumulation years in yellow and your retirement years in pink. That is what we're looking to deliver to participants in the target date fund. BlackRock is looking to deliver 100% consumption replacement to ensure that that black line stays smooth for participants. They're not having a drop down and living.
And Adam, we may have Farzan, are you still there? I just want to see if we still got him.
Can you guys hear me?
Yeah. Okay, you're back. It was breaking up a little bit again, but yeah, we caught the end of it, so we'll let you keep rolling and see if we stay with you.
Sounds good. Sounds good. Please let me know. Yeah, if it keeps cutting out, it looks like it should be okay. But so we want to give that pink shaded area to participants. But we also know, as Adam mentioned earlier, we know that stocks outperform bonds over the long term. We know that accumulation journey as we're going through our working lives is a multi-decade endeavor. And now we've taken 40 years of returns here, going back to 1976, 45 years of returns. You can see that typically equities will outperform bonds over that long period of time, almost by 5% here. On any different individual year, obviously bonds and equities can go up and down and they can be different, but over the long term, there is this equity risk premium that you can harvest over the long term. And so the point is we want to lean into equities for younger participants, knowing that they have this long-term time horizon, 40 years before retirement, and they should be capturing that equity risk premium and getting those equity returns early on and making sure that they have a long time horizon to get that. So that's kind of what we wanted to demonstrate there. On the next page, there's a lot of debate in the target date fund space around early on, do participants need fixed income? Do they need fixed income? And we see majority of target date funds have about 10% fixed income even early on. BlackRock and LifePath has very little fixed income early on. Given that previous slide, we want to lean into equity risk early on for participants, knowing that 99% equities will outperform 90-10 equities bonds 80% of the time. And that means almost $8,000 more of savings or 2.5 years of contributions that participants can save by leaning into risk and leaning into growth when they can most afford to as young participants. And again, the next page kind of gives a little bit more insight into this. We're just demonstrating for younger participants on the left-hand side, 22-year-old, if there was a big market event and equities were down 25%, what would that look like at the end of the day, at the end of the year for that participant? We know their balances are really small when they're young. They don't have a lot of accumulated assets, but we know that their contributions are fairly large as a component of their overall assets. And you can see the math here on the left-hand side. Even if there was a 25% loss in equities in their overall portfolio, at the end of the year, they would still be gaining because their contributions are large compared to their accumulated balance. But for older investors, those closer to retirement, a 25% loss is actually a really, really big deal. They've got this big portfolio balance of $500,000, for example, and that 25% loss is actually quite painful. And you can see the actual number at the end is quite impactful. Point here being younger investors should be able to lean into risk and take on that risk and be buffeted by any big losses because their contributions are large. But those older investors, you need to take off that risk. You cannot be taking that much equity risk for older investors because the impact of those losses affects their bottom line and their balances just that much more. And so that informs a lot of our glide path as well, which you'll see on the next page. And really, you know, what we wanted to, go ahead.
I'm sorry, I was just going to say on that, you know, for plan sponsors right now, I think getting your advisor in, doing Zoom calls, whatever you're comfortable doing, but right now we're in a period where you can't hide, right? So we're talking about equities and fixed, right? Stocks and bonds, and benchmarks across those two are down equally, right? And down 9 to 11%. And it's really scary for retirees who have done this the right way, set it up the right way, and during this very, very short period are still seeing that hit. So, you know, just having the advisor present, making sure there's somebody for them to talk to. There's a lot of really nervous people out there because no matter where you are, you're losing that kind of money. So just now's the time to be active and be sure you have people in front of them.
And I think this is why
that's a really good point.
I think that this is why that glide path is so important. And Farzan, you'll probably talk about this here, but you know, just 2 years ago, we saw an even greater decline than 25%. You know, the market was down 34% during COVID. And so having a very conservative glide path as participants are nearing retirement really worked out well for BlackRock because participants were down just a fraction of that. And so if they were 63, 64 and thinking about retiring in February of 2020, you know, this market downturn certainly wouldn't have been pleasant, but the conservativeness may not have changed their decision to delay retirement.
Exactly, and I think, you know, staying the course for target date fund participants is really important, and hence the glide path that we're showing you here on this page. As we mentioned early on, we want to lean into both. We want to take risk participants can afford to take that risk. So 100% equity, 90% equities. Yep.
And we're gonna just mute Farzan for a minute. Sorry for the continued trouble there. So Farzan, if you can hear us, you were breaking up pretty bad again. But obviously know what you're trying to deliver here. And what I'll do, Adam, for the sake of time as well, and now that Farzan's having a little bit of trouble here, we've got a couple more pages here that really continues on with what he's been talking about. And I'll scroll through a couple of those. But while I'm doing that, we did have questions pop in that I didn't get to earlier. And Adam, I may have you jump in and help me with these. So the first one says, if a participant plans to retire between 5-year increments. So let's say, Adam, that you're trying to you're going to retire sometime between, you know, 2035 and 2040. What do you pick? I mean, is there a right way to approach this? Everybody sort of gets focused on this age 65 or whatever it might be, but they have a range. So does it come down to your appetite for risk?
Yeah, that's a good question. So the way target date funds work is that, you know, they're offered in 5-year increments. So there'll be a 2025 fund, a 2030, 2035, and so forth. And so what if you retire in the year 2032? So, you know, what some participants do is they might have an even split. You know, they might have 50% in the 2030, 50% in the 2035. And so that way you're kind of hedging between those two. But, you know, you might fall on the more conservative or aggressive end. And so if you're more conservative, maybe you bump that up to the 2030 fund. If you're more aggressive, maybe you back that up to the 2035, maybe even the 2040 fund. And so there's no right or wrong answer, but those are a couple strategies I've seen participants employ.
Okay. And the other one that I missed was what happens once you pass a target date, like 2015 or 2020. So I guess I think the question is, once you've entered into retirement, is there a retirement date fund? I mean, what is that, Adam?
Yeah, that's a good question. And it might be helpful to back up to that glide path page.
Sure.
And so this is where the difference of 2 or 3 versus retirement comes in. And so let's just take the case of a 2 retirement. Perfect.
Is this it? Okay.
Exactly. So, you know, here we are in 2022. You know, at one point there was a BlackRock 2020 target date fund, but you can see their glide path stops changing. That mix of stocks and bonds stays at 40% equities in perpetuity once you hit age 65. And so at that point, there becomes an income fund. So, you know, no more BlackRock 2020. That 2020 fund moves into the income fund. And that's where you'll stay for the next 30 years. And so in 3 years, when 2025 comes along, that fund will move into the income fund because again, that's always going to stay 40% stocks, 60% bonds. If you do have that through target date funds, then that 2020 or 2015 fund will actually linger on for a few more years because again, that mix is actively changing every year until in some cases age 95.
Got it. So, really, ultimately, we talked about to and through. Everybody's going to be invested through retirement. It's just really a matter of these firms deciding how much risk that is, right? Are you at 40% equity or more like 15 to 20% equity? Is that right?
Definitely. And Farzan said it well in that it's not, when we say that the glide path isn't being managed beyond age 65, it's not that they're not managing the fund. They're still picking the stocks and bonds that make up the stocks and bonds. But what we're talking about is the mix of stocks and bonds is no longer changing at that point.
Got it. And there's one more I wanted to touch on here, and this is, I think, just a really good summary of what we're talking about with target date funds. And target date funds seek more upside for young investors and more risk mitigation for older investors, right? So that's really what it's designed to do. And I've seen in different 401k lineups, again, with people just who want us to have a look at something that's outside managed, they'll have something like they'll choose between a moderate portfolio or a conservative portfolio, right? Or a portfolio that's going to take on more risk. But those, at least the ones I've seen, don't automatically start to scale back risk, right? You pick it and then you're responsible for going back and remembering, oh yeah, I'm getting older. Let me mitigate some of this risk. So what I love about target date funds is that it's just gradually doing that over time. And these people who have jobs to do and don't have time to focus on this every day, they can be comforted knowing that at least by the book, how you should invest, that's being done automatically for them. Is that a fair summary, Adam?
Definitely. And so what we're looking at here is upside versus downside capture. So upside is looking at, when markets are doing well, how much of that up market activity are you capturing? So if the index is up 10%, what this is saying here is that the BlackRock 2050 fund will typically capture more than 10% return and will typically do better during very strong periods. And that's reflective of their glide path. They're nearly 100% equities when you're 30, 40 years away from retirement. But probably more important, and one of the things we like, is that on the downside, they capture less down market performance for that vintage closest to retirement. So, using that same example, if the market was down 10%, this chart is showing that historically speaking, that fund would have declined much less than 10%, and so is a lot more conservative and does better during volatile times.
And I like, Adam, that you brought up what we experienced 2 years ago at the start of the pandemic in terms of markets, right, where they dropped, I think S&P anyway, dropped about 31% in a very short period of time. What's going on right now is very unusual, right? And that every single sector across fixed and equities is just getting hit hard for reasons that are probably obvious to everybody on this call. But a truer scenario or a truer situation did happen 2 years ago. And a lot of those 60-something-year-olds that hadn't experienced this type of market when they're nearing retirement. I remember one situation where a gentleman called me and he was sort of panicked, as I would be too in his situation, with the markets plummeting down 29 to 31% at that time. And through BlackRock and that automatic scaling back of risk, I was able to tell him that he was down 9% during that time. That's not fun to be down 9%. But not 31 versus 9 shows a true picture of what this can do for people as they're nearing and entering that age. So with that, and
Oh, go ahead. No, go ahead.
No, you're okay. We had some connection issues with you, and it sounds like it's still a little bit muffled. But go ahead and try, please.
Sorry about that, guys. But I think agreed. I think in terms of equities and bonds, it's a really tough time today. But BlackRock includes some other additional asset classes in the portfolio beyond just equities and bonds. We've got real estate in the portfolio. We've also got real return or tips in the portfolio, and those have helped buffet some of those losses that you're seeing in a very unusual environment today.
Yeah, I'm glad you said that. There are some non-correlating positions that are within this, and I'm glad you did bring that up because people can be invested in real assets, which have done pretty well, right? And that's all about what's happening across the globe and the tightening of oil supply. So there's some things that are benefiting, and those are typically the areas or the sectors that you're not going to take huge risk percentage-wise on. But if you're putting 4% here, 5% here, 6% here on some of these non-correlating assets, as you just said, Farzan, that is going to help protect a lot of the return on this and at least mitigate some of the downside that's going on across all sectors right now.
So Zach, I know we have just a few minutes left, but to that point, I know there's a pretty good chart where it shows the different composition of each vintage. If you
Is that
mind
on
backing
here?
up to that one.
Not at
Yeah.
all. One
Right
more, or
after
is
the
this what you're
glide
looking
path
for?
slide.
Yeah, keep going back. One more. There we go.
Okay.
And so, Farzana, if your audio is working, I might ask you a question, but one of the things that I think is pretty interesting is that as time goes on, not only is the amount of equity changing, so it's gradually decreasing over time, but also the type of equity. And so if you look there kind of in the middle, that orange shaded section, that's US small cap equities. And so you can see it's relatively small in the early years, but as you get closer to retirement, it's a little bit bigger. And that's a little bit of a different approach from most providers. Most people think small cap, there's a little bit more volatility in there. And so why would you want to increase an asset category that is a little bit more volatile as you get closer to retirement? But Farzan, you might be able to speak to why that is and, you know, kind of the science behind the glide path.
Yeah, the science is that, you know, it's about correlations as well. So how are these assets moving in relation to the other assets in the portfolio? And what we noticed and what we do know is that small cap equities actually give you that correlation benefit versus fixed income. And so you've got a lot of fixed income in the portfolio as you get closer to retirement, and the correlation between the fixed income and the small cap equities is actually quite different. And so we want to get that correlation into that portfolio. It overall creates a better diversified portfolio and a more resilient portfolio as you increase small cap when you have more fixed income in the portfolio.
Excellent, gentlemen. I'm checking questions one last time, and I think we've covered the 3 that came in. So let me, and I'm sorry for popping through the slide, and to those on the call, we apologize for some of the technical troubles today. In return, and in thanks, we will not read all of this to you, but just going to breeze through the through the disclosures here and get to our final slide, which is going to introduce the Thursday, May 26th Retirement Plan Academy. This is going to be Are Your 401k Plan Fees Competitive? This is going to cover a couple different places, or spaces, I should say. Number one is the people who help you, right? Your record keeper, your advisor, your third-party administrator. Also, what we talked about today, right? And that's the underlying fees that are sometimes so hard to see. And we've talked about just a huge gap between 0.09 and 1.2% in target date funds alone. And that exists throughout all plans, and it's really easy to be misled there. So we're just going to try to help you understand what those are. Be sure you are clear on what you might be paying, and we will plan to see you then. In the meantime, gentlemen, Adam, Farzan, thanks so much for doing this, and thank you all for being here.
Thank you.